Hi there, everyone, and welcome to the last edition of On Track for 2025. How quick has this year gone? It's the 19th of December as I record this. I was in Sydney yesterday for our last investment committee meeting for the year. And yeah, 6 days away from Christmas. So this is my last day in the office for a couple of weeks. And as most of you know, the office is closed down for a couple of weeks while all our team enjoy well-deserved Christmas break. I hope you're all doing the same. Let's get into it before I do a usual disclaimer. All the information in here is provided for clients of McGregor Wealth Management, especially those using our um, care investment methodology and portfolios. Everyone else is welcome to enjoy this, but please get advice or do your own due diligence before acting on anything that I talk about here. I'm going to cover all the usual economic news. I'll do a bit of a review of the year. I know we're not quite finished. I'm doing the numbers as up to end of November, but you'll see from some of the charts. Obviously, there's only a week to go. As always, who knows what happens in that last week, but it's looking like the market's getting a bit quieter. We will see how that works out. In terms of the news, news gets a bit quieter this time of year, but still a bit of stuff happening. In the US, the Fed cut rates by 1/4% to 3.5 to 3.75. They have a range over there. Our cash rate's still sitting at 3.6. It doesn't look like we're going to cut further. Inflation sneaking up. You can see it's about 3.5% in Australia. It's still sticky in the US at 3%. So, but they've got a lot of pressure from Trump and politics to drop rates a bit more. The governor of the Federal Reserve will finish in May. Trump will announce the new Federal Reserve governor in January. It's going to be fascinating to watch who that is and whether they're a true independent or a puppet or somewhere in between. We will see. It's interesting in the last federal Fed cut move, there was four people that disagreed with the move, three that were voting for no cut, and one who was voting for a zero point 0.5 cut. The guy that voted for the zero point 0.5 cut was a guy called Scott Merrin, who's one of the Trump appointees. So you can kind of see the Trump agenda. He wants rates low. The danger of that is it fuels inflation and pushes growth. The growth bit's good, the inflation not so good. Tech stocks have pulled back a little, not a lot, down around 4%. I think it's quite healthy. We've got a bit of a sideways pattern going in the tech market, which is a chance for them to consolidate. Yeah, and I think that's a healthy thing. If things keep going up solidly, there's much more chance they're going to go down. You see just on the table on the right, before I go back to the news, how much change in 90-day bank bills. So that's the rates you're getting on, say, 3-month term deposits. 10-year government bond yields jumped in Australia, 4.73. That's a mixture of the sticky inflation data, a little bit around the mid-year forecast. So our mid-year economic forecast was released last week. It shows, yeah, the government's continuing to get lucky. Every year for about the last 10 years, governments have either persuasion have got lucky because they're raking in more taxes than expected. That's from two components. One is bracket creep, as inflation pushes people into higher tax brackets, but the other is from continued taxes on our mining industry that are higher than budgeted. So while that's good, we've got expenses as shown in this mid-year economic forecast at 27% of GDP, which is well ahead of pre-pandemic levels, which are closer to 24, 25. And it's that stubbornly creeping up that makes us see budget deficits for years to come. And while it doesn't cause grief in the short term, it will eventually cause some grief. So Chalmers is making some noise about attempting to cut that. They really need to do that, or they're not going to be able to talk credibly about any economic responsibility. But it's hard to cut. You've got to make hard decisions about which things to cut. We've got things like Medicare, NDIS, aged care, which have grown astronomically. They're a great safety net in Australia, but they're the key budget issues and very hard to cut. Mortgage rates still around that 5.14, no change in Australia to anything there. And term deposit rates, interestingly, have tipped back up for 1 year to about 4.25. So it's interesting. That's the main kind of news. It's quietening down over Christmas. Yeah, look, this is the end of November. I'm going to compare our returns to sort of market averages in a minute. But yeah, really happy with where the returns have been for the year. Our 1 year returns are a couple of percent above most of the industry super funds, and the 10 year returns really, really solid, as are returns across all bits. We've still got the market at dial at expensive, just at the start of expensive. So we don't think it's crazy, but we do think it's expensive. And that means we just adjust our strategy, particularly for new money coming into the market for our clients to accordingly. And yeah, that hasn't changed now for 3 months, so no change on that. Yeah, I love looking at this chart because it shows beautifully the wall of worry that the market climbs. So in that last 20 years, every bit of the wall of worry cycle is on display here. The boom back in 2006, 7, 8, the eventual bust where the market dropped 50%. And then we've climbed that wall of worry where we've had, since that bust in 2008, 9, we've had 7 downturns of more than 12%. Each one a bit of a panic, each one a fear of something, fear of global economy worsening, fear of European crisis, fear of falling oil prices, fear of rising oil prices. There's always something to worry about. We've got an emerging worry at the moment, not quite 12%, but the markets are down about 5 to 6 at the moment. It's nice and healthy. Corrections bring us back to a steady pace rather than a crazy pace. It's a bit like us. We can sprint for 100 meters, but you can't sprint for a marathon. And investing is a marathon, so occasionally it coming back to a more subdued pace is a good thing. It lessens the chance of this. I've left this in again because there's still news talk. The media, the usual scuttlebutt, loves to talk up a potential bubble. And yeah, I think we're more at the enthusiasm stage. Apologies about my update sticker there. Um, and in some ways, we've pulled back a bit from that. So we're yet to come into that crazy. And yeah, I've got examples of bubbles in 1987 in Australia and 2000 in the tech world, where markets doubled in a year. At the moment, the tech world has doubled in about 3 years. The Aussie market's doubled in 9 years, so not even close. So that's when you know you're in a bubble, when it's just literally gone ballistic. Now, it can still be expensive, still got to be cautious, but not a bubble. And in our exciting life, boring money segment this month, I want to show the result of that boring money because while I often talk about here a lot of the ways that people are losing money and the dangers out there in many areas, this steady march, and I've got a bit of stuff on the screen here, so let me explain. There's a website I often jump to called InvestSmart. It's an investment company that's run by Alan Collar and Paul Clitheroe, who are legends of the Australian world. And they run a very simplistic portfolios of ETFs. They're cheap, but a bit cheap and cheerful. You can see their results, and they're proud of their results, and their results are pretty good. But what I like about this website is they show the average as well. So I've taken their growth fund here, and their growth fund has a 1 year return of 8.2. 3 years of 10, 5 years of 8, and 10 years of 7.5%. So they're good returns. The average, as they point out, of 544 peers that they've quoted here, 8.6, so not a bad month average-wise for the peers. But as you go out further, it gets worse and worse. The 10-year average for growth funds at 5.37%, pretty ordinary. Now, I've inserted there, I've cut and pasted the care growth approach. And over 10 years, it's 8.83. So it's well above, it's a good 3% above the averages. And I want to point out averages is kind of, in the middle. So the fact that we're showing that we're up closer to the top than the middle, don't forget that also means that half, roughly, not perfectly statistically, but half of people are well below that 5.37, which is pretty scary. The average for the last year, while being about that 8.65, we had 11.38%. So once again, really, really solid. And that beautiful, boring compounding at a good rate that's above average. And keep in mind, our goals are simple: above average returns, below average fees, something we've been able to achieve well and truly over the years. So, but I want to show you the difference that makes. So in the top right-hand corner, I've shown a $2 million portfolio, starting at retirement, drawing out 100,000 a year. And at that average return of 5.5%, it runs out over 30 years. Put in our return of 8.8% over the same time for a growth portfolio at 2 million, and at 30 years, instead of running out, it's worth 3.6 million. Let that sink in for a minute, that value of compounding at above average rates, not of spectacular rates. Our mantra here, exciting life, borrow money. We're not swinging for the fences. We're not making big trades. We've got sound principles in place that get this. And it's easy to lose sight of that boring approach sometimes and forget what it's really worth. So it's good to remind ourselves from time to time that compounding at even 1 or 2% above those averages is literally millions of dollars, both while you're building your wealth, but also while drawing it down. From that to boring old bond yields, you'll see that spike in Australia that happened sort of during December, and that's that inflationary fears coming out. That's that fear that we're probably not going to be dropping rates, and whether inflation's a little bit sticky. Inflation at 3.5%, means those longer term rates have gone up. There's going to be pressure on the RBA to increase the short term rates because that will bring back rates in the long term. If they don't do that and inflation gets embedded into the system, then we see outrageously high interest rates, which is we're not heading towards. We talked about this at investment committee yesterday, and in discussing where Emmanuel thinks inflation lands. His worry is slightly higher inflation, but it's slightly higher. It's not 8%. It's inflation being sticky in that 3 to 4, maybe 5% band over the next decade if they can't shake it out. So while that's troublesome, it's not as horrible as the memories a lot of us have from the 80s of 15 to 18% interest rates. But yeah, we need, certainly in Australia, some very sharp economic responsibility, which I hope we get. I don't have a lot of confidence. That will mean the Reserve Bank's got to be a bit harsher, and that can lead to slower growth, higher unemployment, that sort of thing. US, much more stable in those 10-year bonds. They've just dropped rates. They're managing that reasonably well. Their inflation's sticky as well, but it's sticky about 3%. The top of that range, not too far below it. I've talked about our wall of worry and the market displaying that completely at the moment. And I'm going to skip through that. The reason I include this all the time is because there's always talk of downturns, and it's good to look at that chart on the right and see that every major downturn, and there's only 9 over the last 125 years of more than 22%, or 21% is the 9th worst one. Every one of those, the market recovers afterwards, which is why our process of having reserves or dollar cost average through there works so well, because we never have to sell good assets at a bad time. My highlight in terms of the mess it up this month is on performance. And I'm pointing out the irony here, and I know I've just gone through some performance numbers, but we don't focus on outperforming other investments. We focus on us and you, our clients, outperforming other investors, because we know the mistakes people make lead to below average investment returns, but also you're getting below average from the average investments, and then you've got the behavior on top of that. So we haven't changed. So for 30 years, my targets have been exactly the same: inflation plus 3, 4, 5, or 6, depending on whether you're balanced growth or high growth. And while there's been times where markets deliver higher than that and lower than that, that still remains to me a good long-term target, and it's something we've been able to achieve and beat over that period of time. So yeah, and that's without focusing on trying to outperform, and that's because and I'll jump ahead and I'll come back here. We've got our 4 pillars here, from the bottom up: personalized planning, learning from history, managing investor behavior. We talk about that a lot, but because we get that under control, because we get that right, we then squeeze out that little bit above average performance from the boring modern portfolio stuff, which is really good asset allocation. We're currently in the middle of a once in every 5 or 10 years asset allocation review. We will move as usual at glacial pace on this. when we do this, we're looking at, where the world might be heading over the next 10 years, and whether there's any changes required to our long-term strategic asset allocation. And where we make them, they'll likely be modest, not major, but there may be some there. So that's that asset allocation. And then beautiful, boring diversification and the rebalancing. Yesterday, we made some decisions to do some rebalancing. We do that every month, and that just adds value over time by that discipline of rebalancing. And yeah, this is almost the full year to the end of December. It's the performance numbers here are the end of November, but this is shaping up like a pretty typical year. Now, at the moment, it's 5.84 in Aussie, but US about 13.4. You put it together, and you got a growth return of about 12%. And you can see the volatility in the chart has been pretty typical of a year as well. We had a downturn where the market dropped, about 15%, depending on which market you look at. I think it was 17% in the States. And we see that in US shares from 475 down to 400. That was the Trump tariff tantrum or Independence Day, whatever you want to call it, but quickly filled in. And then we've got a little bit of downturn to end the year as well. Very healthy. You look at those, the Aussie market has come back to earth, come off bank, which was vastly overvalued, has come back down a bit. Once again, that's healthy. But in the long run, the Aussie market's been very boring, beautifully boring. Yeah, nine, almost 10% across 3, 5, and 10 years. Yeah, nice. And that's bang on the historical, literally 100-year returns. US shares have had a good run, once again, driven by big technology companies from Apple, Nvidia, etc. And we've seen Nvidia pull back, and you see there on the bottom corner, it's right at the time of writing, it's not quite the biggest company in the world. It's not far off, but Apple's got that reined back. Microsoft not far below, Amazon, etc. So that big tech has really driven those above average returns over the last decade. So over the last 10 years, that's a 15% return, definitely above budget. The debate we have around this is that craziness, or is it just the fact that we're going through a rapid change in technology? It's one of history's big step changes, the automation, the robotics, the AI. There's no doubt it will be one of the biggest changes in history, along with, you go right back to the production line, you go back to the internet, you go back to automated machines that cloud feels. These are step changes in technology that lead to above average returns, and often bull markets and often bubbles that come back to earth. But they do change the world, and there's a lot of profits. As much as you look down the forward PE ratios of those big tech companies, and Nvidia back to 23, Apple at 33. They're high, but they're not staggering. In the dot-com era, those things were up to 50, 60 or higher. In the nifty 50 era of the 1960s, when you had IBM and these mainstream consumer companies, they got up to PEs of 60. So we're not in, I don't believe we're in bubble territory. We're certainly in expensive territory. From here, we always think corrections of 10 to 20% are possible, but it's unlikely, barring major black swan events, to get something more than 20% from where we are at the moment. No, never impossible, but unlikely. Global leaders, much the same, 26% for the year, quite a December. We've got that flattening off, which once again, I'm saying is pretty healthy. And then we've got US small caps. It's been an ordinary year for small caps. Some of you might recall, you probably won't, but 5 years ago, small caps was the star of the portfolio. It had literally 5-year returns of 20%. It's taken it a bit easier. It's fallen into the shadows of the big tech large caps. But we know it's a good outperformer in the long run. We just rebalance. That means we're buying more of it as the prices stay down, and that means taking profits out of the big end of town, the IOOs, the top 100 companies, etc., and putting it in, and that comes off. We had the same issue with emerging markets a year or two ago. It was showing 5-year returns of about 3%. Once again, we kept buying to keep that balance there, and have been rewarded this year with emerging markets delivering a 28% return and a nice comeback there. We're in some interesting conversations around what really constitutes emerging markets. You see the top holdings there: Taiwan Semiconductors out of Taiwan, Tencent out of China, Samsung out of North Korea. There's an argument that they're not really emerging markets anymore, that they've emerged. And we're talking to a provider yesterday about possibly redefining what is an emerging market. Now, they're still potentially emerging. That's the way at the moment that the indexes define it. So we go with the flow there. But there's a mixture in there of these mega caps from China, Taiwan, South Korea, but then the emerging companies of places like Brazil, India, and other places as well that make up the masses there. Gold, what a year, 56% as at the end of November, and still going up. Had a bit of a correction in late October, but it's been a spectacular. Nice to have it as part of the portfolio. Part of this reflects the lack of confidence in economies around the world in terms of their fiscal disciplines. So if a country runs a big budget deficit, say like the US is running, that will often lead to weaker currency. The problem is if all the currencies are weaker, all the currencies are running fiscal deficits, which they nearly all are, there's nothing for it to be weaker against. So it tends to be weaker against things like gold and other commodities. So it's an essential part of the portfolio for us. At a small amount, keep in mind it doesn't produce any income. So you don't want lots of the portfolio in gold, but enough to contribute to the returns. Property, it's been a very solid year in terms of the headwinds and the tailwinds. No change to that. I think I'm going to answer my own question here. I think interest rates have bottomed in Australia. I don't think we're going to go down unless inflation drops dramatically and there was some economic bad news. So if growth started to drop dramatically, if unemployment started to rise, but you don't want to cheer on that bad news just to get lower interest rates. Think about where we've bottomed. We've bottomed at a cash rate of 3.6, mortgage rates of low to mid fives. For a lot of us over a lifetime, that seems pretty cheap. For people who are relatively new to borrowing around the COVID era, it seems expensive, but over our lifetimes, it's certainly not a high rate. And I think it would be considered a low rate. Hopefully rates will stay steady. It's good for economic activity. And we'll see in the next 6 months whether they start to sneak up in Australia. I would say, and when I get to mortgage rates in a minute, if you're tight on cash flow, if your kids are tight on cash flow with their mortgage, sometimes locking in a 5-year rate is good just to be certain. Now, rates may not go up, they may stay steady, but the certainty of fixed rates is quite valuable. There's no change in the supply demand on properties, or it's a steady march at least. We'll do some detailed analysis in the new year, but there's still a shortage of properties. In the last year, we've seen prices go up by 7.5% on average around the country, from the highs of Brisbane and Darwin in the high 12s down to the lows of Melbourne. And the rest of the Northern Territory and ACT at 2s to 4s, but averages there about 7.5. So what that's meant is, that's taken the growth on average around Australia to about 60%. I've got to beware of averages there because in some places it's been 100%. In other places it's modest, like Melbourne. No changes to that on the supply. So there's nothing that's likely to change the property dynamics. I'm seeing forecasters forecasting slightly lower this year, in the 5% range. It's very hard to forecast on a 1-year basis, these things. Interest rates will have an impact. That's the thing that might put a bit of pressure on property price of interest rates. Let's say there were 2 jumps, just that perception. There's been a lot of new entrants coming to the market in the last 6 months, which has pushed up prices at the bottom end of the market, as people go, wow, it's maybe cheaper to get a mortgage than rent. Although unfortunately it's pushed prices up, which counteracts that. Capital cities in the last quarter, you can see they've been steady. You see the charts there, ranging in that last quarter from 1.6% to 7.4% for Perth. Perth's still been remarkably resilient. And it's been probably the best performer over the last 5 years. Very closely followed by Brisbane, although Darwin's having a bit of a comeback. Although I don't really count Darwin as a capital city, it's roughly the same size as the sunny coast, a bit smaller actually. So, but it's interesting to look at it in the figures. This is the annual growth track, so you'll see that drop, where it dropped to a little bit of a crunch pre-COVID, ironically, and then who would have thought? No one predicted it. If you remember, every forecaster in the country predicted that property would suffer during and post-COVID. It actually went through the roof, and we got growth rates that peaked at about 25%. Keep in mind, this is average, so somewhat higher. Steadied again, and we assume property is going to grow about 3 to 5% a year on average, but it's feast and famine. There's years of low growth, years of high growth, and we certainly had our years of high growth, so it's not going to surprise if we slow down a bit there. And in terms of some other figures here, we've got sales activity. This shows the changes in sales volume. So you can see it picking up in some areas. Darwin, ballistic. Once again, it's a small market. Same with regional Northern Territory. The national results are pretty boring on average, just a steady 3.3% increase for the 12 months to November. That's about inflation. So that kind of tells me there's no real change in the volume onto the market. And this is that monthly sales, with the 6-month moving average, in terms of, and that's how many properties go on the market, every month, and that's the average. So the Australian market turns over about 45,000 properties a month. It's a pretty solid market, and it's slightly above average at the moment. Not much to read into that, but interesting. Mortgage rates, as I said, probably bottoming. You see that drop both in the averages and the variable. I would point out these averages are the headline rates. So with all banks, you can get better than that as a variable rate. You've just got to ask anywhere from 5.1 to sort of 5.4 is a good rate. If you're actually paying 5.8 or anything with 6, you should be looking at renegotiating or refinancing. Yell out if you need a hand with that. We've got some great people we work with who are very good at getting lower rates. And you can see there the 5-year rate down at about 5.65. There's a few in the marketplace better than that. 3-year at 5.32. So there's 2 reasons to fix rates. One of them is if you think rates are going lower. That's pretty hard because it's hard to predict. And I've seen people, including myself, get that wrong over the decades. But the other reason that's a good reason is if you want to lock in your cash flow. So if I was buying an investment property right now, and if my cash flow was tight, I'd lock in that 5-year rate, knowing that if my cash flow works now, if rates go up, I'm not going to be forced to sell a property because rates go up. So sometimes you lock it in. Maybe you'd be tempted to do that in a 3-year just to squeeze that a bit lower. 1 year's neither here or there for certainty because you've got to redo at the end. How will rates respond to if the RBA does start cutting rates in the new year? We'll probably see rates sneak up another 0.5% is possible. Maybe they don't. Maybe we'll get some negative economic news. Maybe inflation pulls back a bit. But maybe we'll be stable at this rate level for a while. That would be nice. But we'll wait and see what happens. None of it matters in the long run because it's all about what you do, not what markets do, which we'll sum up in a minute. No significant changes here. The property clock is still showing. Lots of those. It's funny. The blue ones in our performance property clock here, the dark blue is what they would consider foundation assets or blue chip assets. And you might hold from 10 years or to ever if you've got an investment property. So Sydney's a great example. Just the fact that it's going sideways or it's stagnated a bit. It feels like it's always there, but Sydney has spectacular returns over time, and it's a great blue chip investment. It's just always hard to buy it at value. It does happen. It's been a while. Melbourne, however, it's been the opposite. It used to be the opposite. So Melbourne has always been a great long-term return for the last 5 years, particularly since COVID. Melbourne and Victoria, to a lesser extent, did not deal with COVID well. There's still a hangover from that in terms of massive government debt and other things. So that's taken a toll on the lack of growth down there in property prices, but we're starting to see it enter the value zone. And some of the people we work with are saying that's, yeah, it's a good place to be buying. Keep in mind, whenever you look in a market like that, it always feels a little bit scary because it hasn't done much, but it would be almost inconceivable to think that Melbourne doesn't return to, to the relativities. At the moment, properties in Brisbane and Adelaide and Perth are more expensive than Melbourne. And that doesn't make sense in our long-term natural disorder, unless Melbourne went into some sort of terminal decline. But the beauty of our economics and politics is, things change over time. Victoria was in a pretty fragile state in the 80s after firstly the Kane and then Kerner governments put Victoria in a similar place where they are today. But then along came Jeff Kennett, who was unknown when he came in. He was considered, I think his nickname was Buffhead. He was considered pretty volatile as an opposition leader, but he proved to be a great leader. He reined in. They sold assets, they paid back public debt, they got Victoria into great shape where it was booming. That will probably happen again. Doesn't feel like at the moment, and let's hope so. It's a great city, and eventually there's probably some really good value. So we are considering that. I've got investment properties in Melbourne. I'm definitely not selling from where they are here. I think they're almost at half the price that comparable areas in Sydney would be, and it just doesn't feel like that's the new long-term normal. Be careful as always with these buying. It's got to fit your long-term plan. You got to be able to stick out these long-term moves. And in summing up, and I will say Merry Christmas, Happy New Year. Hope you have a great, well-deserved break. Hope you've got time with family and friends. But just in wrapping up, our exciting life, boring money process. We invest always only when we've got a plan for you, which is where we've got your goals and we understand who and what's important in your life. Portfolio is designed to meet those goals, and it has. And then some. We take a long-term view, which allows us to ride through all the noise. Once we manage all those behavioral things, etc., then that beautiful, boring diversification, asset allocation, liquidity, all achieved at a low cost through index funds, gives us those above average long-term returns. And protecting against short-term volatility, which we know is inevitable through dollar cost averaging for our wealth growers and for reserves for our clients in drawdown phase. And that's meant our clients don't have to, don't have to sell good assets at a bad time. There is only three ways to lose money in the share market. Panicking and selling when the market's down, having to sell when the market's down and not properly diversified. And I can put my hand on my heart and say none of our clients have done that this year, nor for quite a while. And well done on that. Once again, thank you for listening. I know this is sometimes repetitive, but the idea is to reinforce not only the process, but help you interpret the news and the stages that come out of the media into less important than they usually are, or reinstate them if they are important. Forget about all this for a while. Enjoy Christmas, New Year, and we will talk in the new year. Until then, Rob McGregor signing out.